that?
I just said I'll move the resolution.
Oh, thank you. Do I have a seconder?
Yeah, happy to second it. Yep.
Okay, I'll put that. All those in favour, please say aye.
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 Those against? It's carried. Thank you for that. Appreciate that. And thank you for covering there, Sandra. Paku, the health and safety report.
Yep.
Yes, so the health and, through the chair, the health and safety report follows the normal format that I've produced the last couple of meetings. There's a couple of things I just want to highlight in this report, and that is that we are starting to now really zone in and focus on the positive actions that we can take to address the nasty 9 risks that we've identified. And one of those things is the driving, which is by far the area where most incidents for council actually occur. So we've rolled out a great vehicle training tool that 50 of our significant users of vehicles in their role get to use, and it's very useful. And the other area that we looked at was in the other area that's significant is personal confrontation. And I know that our customer service staff have undertaken training in that area around de-escalation. And so that's a good piece of work that's occurred over the last couple of months. And we also looked at some of the other areas around asbestos and what learnings can we take from that. That was great. And we've also, in the area of staff engagement, we've looked at developing a group around staff wellbeing, which we've probably not had before here at council, and I'm really interested in making sure that we do have that with some of the wellbeing initiatives that we can pull for staff. Really, that's it. In the as you know, we've got a new health and safety business partner, and he has been out and about engaging with our contractors, given that they are really where our significant risks lay. And he has been going around and meeting with their contract managers, and also going out on site to actually really get an idea of what's going on in our RTS sites, for example, and our water treatment plants, etc. So he can really start to kind of learn what those hazards are out there and provide support to our staff and to the contractors. So that's really kind of articulated through this report.
Thank you, Paku. That's I get a stronger sense that we're honing in on the real stuff. So that's really great. Could I have open it up for members to raise questions to the report, please?
Yeah, it's Martin. I've got a question just around the on that table on bottom page 33. You talked about additional security measures at the Thames service desk. So I guess I was wondering, was there anything in particular that had made those that made people aware that that was needed, and are they physical security measures, or is it just around getting help if it's needed?
No, it was a physical intervention. It was actually the door that between the custom service area and the staff. That door was really not locked at all, and we've put a swipe mechanism on there so that only staff can access that back area. And really that's about, you know, if someone, we have a really aggressive customer that wants to physically hurt our staff, or that they can retreat to the back of the building without that person, you know, getting around and getting access to that area behind them.
Thank you, Martin. Are there any other questions?
Yeah, I've got one if I can, Paku.
Gary?
It's around that vehicle training with the visual training, virtual training. So it's on a monitor of some sort. How is that completed?
It is, yes, Terry. I've used it and it's fantastic. Basically, what you get is your screen, the computer you're using right now. They produce the dashboard of a car, in fact, and what you see is the road in front of you. And so you're looking as if you're in a car going along, and you're seeing the road in front. You're seeing obstacles coming at you. You're looking at the road signs are coming towards you. So it's virtual. You're in the space, and you're using your computer to navigate around those obstacles, brake, and also speed. So it's really useful as a training tool. It's practical. It's practical. And I'll tell you what's really interesting is with lockdown, we made it available to 50 staff, and I was talking to our health and safety advisor, and he said that since lockdown, all of our staff have got on and done the training because they've got the time to sit and do that.
Oh yeah.
And he's received really positive advice back, really positive. And look, it surprised them. It's surprised that they've either driven too fast, or they've taken a corner too fast, etc.
One of the issues that I remember when I was with the company was backing. We had a lot of backing accidents. Can they do that on this? Does this provide that kind of service or facility?
Yes, everything is involved, is part of the graphics. Yeah.
Thank you.
Sandra?
So is this owned? Is this an app that we have, and are we obliged to only be able to share it with staff, or can we share it with the elected representatives, or even with the public? Because I'm thinking about the improvement on driver safety, and I'm sure that Tony would be wanting to be in this space, but improving driver safety, what a great thing for people to have a go at while they are in lockdown, to just get a sense of what they're driving and how their driving might be improved. I mean, is there a cost to this every time somebody uses it?
Yes, it is there is a cost. We've outsourced this, so we obviously get 50 licenses, and they cost, I can't remember what the cost is, but yes, it's an external provider. They provide us with the license to go in and use the tool. The drivers that have those licenses get full use, and they can go back at any time and use it. It's a difficult one because we had we decided that we would go with the 50 that were the high users at this point because it's cost prohibitive. I hope has that answered your question. So we won't be.
No,
we
so
for example,
I guess that we can't buy an app that we can put online that anybody can use to download it or whatever and just go for it.
No, unfortunately, not. It's
It's all right. I would have loved that opportunity.
I understand.
Free driver training would have been awesome. Anyway, thank you.
I understand Murray might pay Tony to have the 51st license. So it's a joke, Murray.
Why
Paku,
Tony being targeted here?
With that driver, I hope we're allowed to have jokes on this, Tony. With that training, how do you know that it's been, do you get the metrics or something, the feedback that actually, one of these high vehicle user people, A, have done it, B, they've learned something, C, that it gives a chance to have that implemented on the field?
Yes, we get the metrics. Yep, we do.
Great.
And so
That's good. Okay, thank you for that. And actually, Sandra, you actually do raise a really good point. I hear your point about the public, and perhaps we can't go that far. But you're actually hinting at, I think, at a very good point, and despite my jibe at Tony, reality that our members themselves are probably high vehicle users around council business. And I appreciate that that's not a you know, we have to recognise who are employees and who aren't. Paku, I wonder whether it might be just worth knowing what it would cost to have some additional licence if we could extend that. Just it's worthwhile the information without saying or committing to that being of something that we would be able to proffer. Are there any other questions for Paku on the report? Well, thank you, Paku, for it. It's I think giving us a much stronger sense of drive and action in this area, as I said at the start. So I appreciate the report and indeed your business partner, who I'm sorry I've forgotten that person's name, but do appreciate that.
His name is Steve Green, and he's from, and we took him from he's from Coromandel. He's based in Coromandel, and he's
Right.
He worked for the mussel farm down there for years.
Right. Okay. Oh, good. Well, perhaps at some stage down the track we'll get a chance to meet Steve as well. Hopefully we're all in person. Can I move to the resolutions, please, that we receive the report?
I'll move.
No. Thank you. Do I have a seconder? Thank you.
Sally.
I'll put the motion. All those in favour, please say aye.
Aye.
Those against? It's carried. Thank you very much. Right, we have really a report for our information, which is the LGFA quarterly report. Donna, is there any key point you want to draw to our attention as far as this is concerned?
Well, in my summary there, I've just picked out some of the key points. I guess, like from a perspective of their KPIs, they have met all their KPIs bar one, and the one that they haven't met is the one around having the market share of borrowing across councils, which isn't really something that they can probably directly control anyway, but that's also because of Auckland Council is the main reason why, because they like to spread their risks from borrowings across various other entities. So all in all, I think that's a pretty good result for the last quarter of the financial year for them.
So I have a question.
Sure.
So my question is, has the government made any, or sorry, more like the local government funding agency, has it made any indication to you of discussions with the government around amending the constitution to allow the new water entity to borrow from that fund? Because
no.
Thank you.
As far as I'm aware, no, those discussions may be occurring, but they haven't certainly made them public. Some of the finance staff went to the LGFA Borrowers' Day a month or so ago, and that question was raised, and I think that, yeah, it's something that is still yet to be worked through with them.
Thank you.
Donna, if I can ask a question, it says here that there has term loans to councils for the quarter of 829 million, more than twice that of the previous quarter. Can you just give us an understanding of why there's so much more borrowing going on?
That will be, I would say, because there'll be loans in the last quarter. It's around the timing as well. There'll be loans in the last quarter of some big bonds paid back, and then there was a big bond done in the last quarter. And also, I guess towards the end of the financial year is when everybody is finishing off their capital works projects, and that's when a lot of the borrowing does occur in the last quarter.
Okay, thank you.
So they suffer this. They suffer, or rather, their performance hysteria is as much dictated by when and how local government performs, and it's always that rush towards the end of the financial year.
Yep.
Any other questions, people? There's hello, Brett. Welcome along. I'll make you earn your keep. Is there anything that you would observe for us about the LGFA at this stage? We're still quite comfortable getting money out of them, I take it? We should be?
Yes, absolutely. They've certainly been operating effectively in terms of accessing debt capital markets is what we want from them, and as we'll see, the debt they're raising is at all-time low levels as a margin over wholesale rates. So yeah, no, they're doing a good job.
Brilliant. Thank you for that. Well, timely entry to the meeting. Are there any other questions from members for Donna over the quarterly report from LGFA? Great. Okay, thank you for that. Well, look, if we could just move to the motion then, please, that we receive the report. I'll move that. Do I have a seconder, please?
Second.
Thank you, Murray. At least I probably heard a voice and a hand, but I got Murray's there. All those in favour, please say aye.
Aye.
Right.
Those against? It's carried. Thank you very much. Right, let's move on to, indeed, your timing is impeccable. So look, what I'd like to do is we've got items 4.2, which is the Treasury update, which is Hayden talking to us about our own position, and then we do have Brett over the broader update. So what I really propose to do is that we will actually take these two papers together. So Brett, if I could ask you, sorry, Hayden, if I could ask you to speak to your paper first about our position.
Yep.
Brett, I'd like to then invite you to speak to your broader update, and then I would like to return to the motions that are in papers 4.2 and 4.3. So we've got a complete picture as we deal with those, if that's okay. So Hayden, if you would like to take us through your paper first, we'll then, Brett, invite you to present your update to us with the attached slides that have been sent through. Thank you.
Okay.
Okay, I'll take the report as read. But through the chair, I think it's just the report's really sort of detailing, given an overview of where we finished the financial year for 21. We finished with $61 million of external borrowings versus a budget of 69 million, and it was lower largely due to more favourable operating performance than more favourable operating performance and timing of sort of associated capex program of the associated capex program.
Our capex program was always probably going to determine our net debt position at the end of the year, which is probably true. Any questions from members at this stage, please, about the and appreciate the sort of the short form summary of where we as a council are at.
Yeah, can I ask a question of Hayden?
Yes, Terry.
So that borrowing you've got there, is that all through a series of loans, obviously, and swaps? Is that right?
Through the chair, it's a series of loans, yeah, with our GFA.
Okay. So those interest rates you're paying on those, are they long-term interest rates that are most probably favourable now, or we're still in some high areas of interest rate repayments?
We have a mix of interest rate swaps and loan rates. We did a blend and extend exercise I think it was last year, which basically we exited a lot of our sort of higher interest rate swaps. So yeah, our swaps are quite favourable. Overall they're quite favourable.
So what's favourable? Are we talking 7% or 4% or what?
The average is it ranges from about now probably 3 to sort of 5%. I think 5% is our highest one from memory.
Okay.
And some of them are lower than actually.
Which we were around the 7% on some of them, weren't we?
Yeah, we were. We had quite a few higher than that. I think the average is about 3.5. Is that right, Brett? That's our weighted average cost of borrowing.
Okay.
Certainly, the weighted average swap rate has been coming down over time as those older swaps have matured, and as you say, you took the opportunity when the curve was lower and flatter to do some reprofiling of those swaps. That created the opportunity to.
Right. So the outlook, do you think there's some inflation in the winds? Is there some expansion of interest rates going forward?
Yes, and the first part of my presentation will focus on that. Yes. Yeah. Yeah.
And I see assumption 3 is that's with the water debt forecast, so that we dropped from the 107 down to the 44. That's showing that transfer of that assets across into this new entity. Is that right?
Yeah, the transfer of the debt, or the pay, the exiting of the debt.
Okay. Okay. Thank you.
We have to think of that
right.
very with our total financial strategy, because of course we've also lost the revenue side. And you think about the way, if you think about our debt limits, it's backed by our revenue. So you've got to have your total financial strategy in play. Looks good, but you've got to balance it against what you can do. Are there any other questions for Hayden? Or indeed, poor old Brett, he's already into the job already. It's fine. Are there any other questions folk would like to raise at this stage? Why don't we move, Brett, to your presentation? It means then we can hear the broader view and the specific views that you have, which means then we can come back and look to even ask more questions over Hayden's report around our position, and more importantly, move to adoption where we can be comfortable from a risk perspective in the position that we've reached. So could I invite you to perhaps head off into your presentation? That might be helpful, please.
Can we have the presentation on the screen?
Yes, I'm going to do that now.
Thank you.
So bear with me. I'm just a couple of clicks away.
So I would note for members that actually Donna, I think, did also send it out. So if you had a second screen, you can also follow it on your own screen, I suspect.
Yeah, I've got it here as well. Thanks. Yeah.
Is there something up on the screen now?
Yep.
Yes, we can see it. We can see it. Okay, Brett.
It's a treasury management update.
Yes, that's what we've got.
Great. Okay, so I'll look. Thank you everybody for inviting me to present this morning. Sorry I can't be with you, but we're certainly showing flexibility, aren't we, in terms of the way that we're all working at the moment. Look, what I wanted to do this morning is just an update on the economic and financial market outlook, because yes, there's quite a bit going on at the moment, and certainly I'll focus on inflation in New Zealand. And then the next part of the presentation will be, so what does that mean for council, and what are we thinking about as a management team in terms of managing those risks on a proactive and forward basis. And then I'll sum up, provide a summary. So in terms of the economic and financial market update, so what we sort of first do is we look at what's happening globally. And this chart here, is you'll see, is a PMI chart, so Purchases Manufacturing Index. And it's actually a good lead indicator to what's happening globally in terms of manufacturing. And you'll see there, I know it looks probably a little bit spaghetti-like, but it's really focusing on the major manufacturing economies across the globe, in particular China. And you can see last year across the globe we went into the COVID-19 lockdown, but what we saw post that, as we did see in New Zealand, is a very sharp increase in activity post the relaxing of strict lockdowns. And when we look at this chart, where we see lines above 50 means that the underlying manufacturing base in those respective countries is expanding. Typically, if we go into a recession, would be below the line, above the line expansion. So certainly across the globe, we've bounced back, and activity has been relatively strong up until now. And you're starting to see those lines sort of start to move down the page towards 50, and a lot of that is due to concern around the COVID variant globally. With vaccine rollouts, certainly have been very good in the likes of Canada, US. The Europeans have sort of picked themselves up there, and the UK as well. But as we've seen in Israel, which is very highly vaccinated, daily case numbers are starting to increase rapidly, and there's some concerns around the efficacy of the vaccine. And then you're starting to hear more and more talk, particularly out of the US, around a third booster shot or booster jab. But I suppose that globally, when manufacturing or economies are starting to sort of come off their highs, and we look at China there, it's barely expanding, and China's certainly got a problem with the Delta variant at the moment. As we do start to see commodity prices start to reduce, and we've sort of seen that in terms of oil recently, we've seen that in our whole milk powder prices as well. And it's important for us in terms of when we look at ourselves as an exporting nation, what's got us through very well to date has been high commodity prices, a relatively low currency, and that all flows positively into New Zealand Inc.
Can I ask a question?
Yes, indeed. Sorry.
Yeah. So how does the supply chain fall into that last curve as it starts to fall off? Is that part of an impact on that?
Yes, absolutely. Look, manufacturing has been constrained by supply chain disruptions, and we sort of hear a lot around semiconductors and those sorts of things, and that sort of had an impact in terms of manufacturing of motor vehicles, for instance. And also that is increasing prices, and you're certainly seeing that in New Zealand when we see inflation now at 3.3%. A lot of that increase has been driven by supply chain constraints, particularly in what we call the housing group around construction costs. So yes, that is having an impact indeed. So it needs to be sort of brought into the reflections in terms of growth. And with the economy in New Zealand, look, end of this quarter we were at 2.4%, so we have absolutely bounced back more so than we thought, but we are going to push against those capacity constraints, and that'll be the supply of goods and services, but also what we're seeing is across the labour market as well, and across the business confidence surveys, particularly construction, we're seeing no spare capacity at the moment. So with borders closed in New Zealand, the flow of labour is obviously stopped, and that's causing constraints around growth. It's also flowing through into wage price inflation as well. So the unusual state that New Zealand Inc. is in is certainly sort of flowing through into inflation and sort of the growth outlook.
Can I ask another question?
Yes.
So New Zealand's got an approach to COVID at the moment of a total eradication, and everything's focused around making sure that COVID's not in New Zealand. The other overseas countries, and especially Europe, have a different approach where it's all about vaccination and getting back into the workforce and getting the economies going. Do you think our course is the right course or not?
This is probably a personal reflection, Terry, but yes, I think we've sort of benefited from that elimination type strategy. Certainly, if we look at activity and just general sort of lifestyle over the last sort of 12 months. So I think we're in a situation where we need to adopt an elimination strategy, particularly whilst we have a population that needs to be further vaccinated. And ideally, we want to get to that 90%, don't we? And we seem to be on our way heading towards that level at the moment, given the sort of like uptick in people getting vaccinated in their first jab, and obviously assuming supplies are on stream, their second jab in 6 to 8 weeks time.
Right. Yeah, Pfizer came out yesterday and made a comment about the fact that its efficacy is only for about 6 months. So they're looking for a booster to replace that going forward, which adds another little quirk to the discussion.
Yes, yeah, you're hearing more comments about that, aren't you? It's going to be a regular booster that we're probably going to have, like our flu injection every year.
Agree. Yeah. Okay. Thank you.
Yeah. So in terms of New Zealand Inc., and I suppose this is seeing some of the positivity around the strategy that we've taken around sort of COVID. We've had massive fiscal stimulus, particularly around the wage subsidy and also monetary policy stimulus with low interest rates set by the Reserve Bank. And when we think about where house prices have gone to over the last year, 30% up, that is very different to what Treasury were forecasting back in March, April last year. They're forecasting more of a reduction in house prices, but that leads through to positive consumer confidence, and we see here how consumer confidence has again done that V-shaped in terms of bouncing back up, because it does, for those that do have houses, it increases the equity position in the house, and that really sort of buoys that net wealth effect. And when we think about consumption in New Zealand, 60% of our GDP is related around sort of everyday economic transactions that consumers make. So to have a confident consumer means that they will be spending. And
is that dangerous, Brett?
Sorry?
Is that dangerous to have so much wealth tied up into a residential housing or housing to that degree without going into manufacturing or other options?
Yeah, look, I'm always a fan of diversification, but it has been to date a cultural part of the way Kiwis look at themselves, owning their own house. I think what is important is probably the financial stability piece, in terms of higher indebtedness, particularly private debt in New Zealand, as these house prices have increased. And what does that mean for financial stability around higher interest rates and higher mortgage costs? Murray, have you got a question? Sorry.
Yes, Murray's got a question, I think, Brett. Murray?
I've been listening careful to what Brett's saying, and I have a real difficulty in today's environment reconciling what you've said. The CPI with eggs and oranges is 3.3% or something.
Yeah.
And yet I look at our house borrowing at an all-time high. I look at we talk about the equity in houses, but that money's really been deflated. I look at our other costs. I look at our fuel costs have gone up probably 20% in the last year. I look at our building materials have gone up 20%. I look at our groceries have gone up. I look at all the other things, and we're getting fed this 3.3% inflation. Yet I've got a real suspicion that probably running in terms of actually spending power, more like about 12% in terms of the devaluation of money. Because while our houses are going up and a house might be worth 1.5 million, it's actually worth no more to us than what it was when it was 800,000. So I look at the confidence, and I look at these graphs and this graph that's there, and I think there's a false confidence out there. I really do. I just look at your comments.
Yes, and I think that's right, because there are different types of consumer out there, and and what sort of makes up the bulk of the demographics around an economy And that is exactly why our Reserve Bank has a mandate over the medium term to maintain inflation between 1% and 3%, and they're targeting 2%. And therein lies their current thinking, Murray, around the stimulatory impact that
I accept that, Brett. I accept that, Brett. And I suppose what I'm saying is the CPI, and I said facetiously eggs and oranges, is the CPI an adequate measure, which was used by the Reserve Bank and others? I think there's a lot of other factors that are outside that are driving inflation a lot more.
Yes, so yeah. Look, that basket is reviewed regularly, and it's supposed to represent sort of like a common basket of goods and services.
I know,
yeah. So they've taken out sherry and spa pools and put in, other goods and services. But you're right, from a local government perspective, CPI doesn't make much sense. It's rather the local government price index, because the basket of goods that you would be purchasing as a council has probably got a high weight towards bitumen and oil, right? And
I just want to say, I think the construction price index will be far better than the CPI in terms of where inflation.
Exactly. And look, within the CPI basket, there is a housing group segment, but it's only a small proportion of the total of the whole. And in there, you do see higher construction costs, higher cost of construction material, also higher energy and electricity costs, higher rentals, and they're feeding through into that 3.3%. But yeah, it's going to be proportionally less, because of the way that the CPI basket is constructed.
Okay.
I think, again, just a comment around consumer confidence and activity. We have seen unemployment go down to 4%, and the Reserve Bank would see that as being fully sustainable employment. Again, we're in a better place than we thought we would be when forecasters were more pointing to 7-8% unemployment. I'd have to also note that there is this underemployment piece as well. And this chart here is New Zealand job seekers. And you can see really we've still got people on job seekers that were not on job seekers prior to our lockdown last year. And it's really sitting about 10%. And that's the skills mismatch that we're seeing in the economy, right? In terms of, although vacancy rates and job ads are at high levels, the skill mismatch is there in the economy. So there is it's going to take some time for that structural imbalance to work its way through, but also the fact that obviously closed borders means that it's hard for businesses to get skilled labour, and that problem is not going to go away anytime soon.
Yeah, Brett, got a question there. So yes. Yeah, it's around obviously the unemployment. Do they take those figures into the amount of people that have been employed for the to deal with COVID? Is that part of the permanent employee list, or is that just a temporary and it's only not included?
They should be included there.
So what happens at the end of that time? Do they all become unemployed again? Well,
they potentially could do, yes. But
and on the job seeker one, you see a lot of people coming back from overseas for good qualifications. But at the moment, when job seeker, you talk to people, they say they try realigning their lives because of the changes coming from government. Is there a bit of? Can you comment to that?
No, I haven't. That's a comment I haven't heard before, Terry. Sorry. But what are they saying? They're actively looking for work and can't find it.
Well, they're looking for job opportunities outside their normal one as the changes are coming from government in different directions. So they're looking to realign themselves with maybe a new career or a new pathway. So that's what I'm hearing anyway.
Can I just finish? I'm conscious of everybody's time, and I got some more questions. Terry, it's a very interesting discussion, but I think our role here is to understand the broad brush of the economic analysis that Brett's giving us, so that we can return and consider whether our own settings within our treasury management is right. So I want to keep it reasonably close to the topic of Brett's presentation, if that's okay.
Yeah, I appreciate that, Bruce. It just sometimes figures, statistics paint a picture that sometimes, we get a different feel about what's going on. But I hear you. Okay, I'll shut up.
Point, man. Murray, but I do think you might have put your hand up subsequent to me intervening, Murray.
Yeah, and I just want to add a comment to the last slide. When I look at that, bear in mind there's a balance, and I just add this as a balance to Brett's comment, that we've got the highest number of people on some form of benefit than we've had in our history right at the moment. And to try to get those figures, they've changed the format of publishing and they're difficult to get. But if you go through, you'll find it's the highest number ever. So I just offer that as a balance.
Thanks, Barry.
I think that's consistent with where we're seeing that job seekers, isn't it? It really, we haven't been there, over the path of the series that I've got on the chart. So this is the underemployment piece, which really these people there that are wanting to work or work more hours but aren't able to, because there's this disconnect between with the skills mismatch I was mentioning. If I'll carry on. Look, this chart here is again just showing that sharp pickup in activity, and a lot of it is driven much. We have are doing more travelling around New Zealand. It's fair to say we're doing more DIY, and that is sort of flowing through into the positive activity measures as mentioned earlier. But what is flowing through and is inflation, and here we have businesses in terms of this, the ANZ business confidence. Businesses, because of supply chain disruptions, input costs are going higher. Certainly they're paying more to keep their people. So there's a bit of wage inflation there as well. And it's starting to flow through into annual CPI, and that was at 3.3%. Look, our Reserve Bank is expecting that CPI measure to move higher by the end of the year, but then come down middle of next year back to that 2% mid-range. So a lot of that peak is driven around temporary measures, which are very much related to closed borders and the unusual situation we find ourselves in at the moment. But nevertheless, there is demand in the economy, which is giving businesses the confidence to increase prices, and they're able to secure those increased prices. So the Reserve Bank is very much mindful of high levels of demand across the economy, and they're wanting to reduce that demand through their policy settings. So the next chart is the wholesale interest rate chart in New Zealand. So this is what we call the interest rate sort of swap curve, and this is the price in which interest rates are bought and sold across a 10-year term. And we do hear, obviously, in the media a lot, the official cash rate, and that's the rate that is set by our Reserve Bank. So what we can see is our interest rate curve has, from May to now, has increased, particularly in this area here in the next 3 to 4 years. And that has been driven around changes in commentary from our Reserve Bank, because in September, October last year, they were talking about negative interest rates in New Zealand. They quickly pivoted away from that. And in May, they were talking about the second half of 2022, they're going to increase the official cash rate. Now they're talking about, well, we would have done it in October last week, but we didn't because of this level 4 lockdown. So they're very much of the view that the demand across the economy needs to be slowed down to manage inflation over the medium to longer term. So that's quite a change in the way that they've been communicating to the market. But the market has responded by expecting interest rates to increase over the next 1 to 3 to 4 years. And you've certainly seen some banks increasing their mortgage rates as a result of interest rate markets increasing their expectations of higher interest rates. We would say that the interest rate markets have gone too far, too fast in terms of the expectations around these OCR increases over time. We believe, in our view, that the Reserve Bank will want to take out that emergency stimulus and move that OCR close to sort of 1% by middle of next year, and want to hold it there to really understand the impact of those interest rate increases. Because we've got to remember that, yes, we're a lot more indebted than where we were 2 years ago. And there's a higher degree of sensitivity to interest rate increases now to what there was. And when we think about mortgages, probably about 80% of them are repricing or refixing in the next 12 months. The impact of those increases in the OCR will be quite immediate. So the Reserve Bank won't want to be where they were back in 2013, where they increased interest rates too quickly and had to quickly remove those interest rate increases. They're going to be probably, in our view, more circumspect about those increases, given the increased level of indebtedness across the economy. But I think one of the important observations for us is that the curve has got higher at this part of the term structure, but it's been anchored at the long-term interest rates and the 10-year rate. And remember, the 10-year rate is very much driven by what's happening in the US market. And because of this increased uncertainty around the COVID variant and the efficacy of the vaccinations, that has actually driven long-term interest rates out of the US lower, and our curve is flattened. So when we're thinking about managing our interest, we're actually thinking about our interest rate risk out in that 5 to 10 year period. And as rates have actually become lower because these rates have gone higher from where we were earlier this year. So when we think about council's exposure to interest rate risk, about 70% of your near-term interest rate exposure is hedged or fixed through either fixed rate debt or swaps. So we're thinking about those longer term interest rates when we think through the interest rate exposure to council from a long-term intergenerational perspective. So we think about our borrowing costs, and there's two components of it, isn't it? There's that wholesale interest rate risk, which is driven by not only the central bank here in New Zealand, but also what central banks are doing internationally. And then we have the other part, which is the credit margin we pay over and above those wholesale rates. And that's when we borrow from the LGFA, the local government funding agency, And important to note is that these are the spreads that we pay over and above essentially BKBN, which is sitting at about 0.4% at the moment. This is 1% or 100 basis points, but you can see the trend has been lower over the last year. This is the spike we had when we went into global lockdown last year. You can see how rates went up very high, but have since come down as market conditions have normalised, and our Reserve Bank has been in the market supporting the buying of local government funding agency bonds as well. So that's sort of helped in terms of keep those funding costs or those credit margins low for a period of time. So they're at historical lows. And when we think about that and we think about our debt funding maturity profile, we would be wanting to go and raise long-term debt now to be able to sort of capture those good, very attractive long-term rates. Now, just remember that the Reserve Bank is no longer in that market buying LGFA bonds or having the capacity to buy LGFA bonds. So some of those positive influences are probably not there to the same extent now. And that would be our reasoning and rationale for wanting to go and lengthen the debt portfolio while those credit margins are at good competitive levels.
So can I ask a question around here, because the government is talking about potentially modifying the constitution of the LGFA to allow its corporate entities of the three waters to borrow through LGFA, predicated on the assumption that they'll have ownership of the assets, even though they pretend to suggest that we might retain ownership. So I would have thought that, or my question to you would be, do you think that the direction that the government's going in on three waters is part of the reason why we've had this reduced effect for the borrowing through LGFA?
No, I don't think it's directly related. I think, this is very much related around the fact that the LGFA has got a AAA credit rating and a semi-sovereign. So that's a very attractive investment asset for international investors and banks. And certainly in a period of uncertainty, where do investors like to park their cash? They like to park it in the safest place possible. And you can't get safer than a AAA rated issuer or entity. The New Zealand sovereign and the LGFA, which has the same credit rating as the sovereign. And that's really helped in terms of just that demand for those investments. But we would say over time, as the risk sentiment improves, there's probably going to be less appetite to be holding low yielding, high credit quality assets, and so you probably wouldn't have the demand for these bonds as you have in the past. So that would tend to suggest that your credit margins would start to increase from here. I think in terms of three waters and the funding of three waters, not a lot of detail at the moment, but my understanding was that those entities were going to be separately credit rated. And they would go to the market and raise their own bonds. In some ways, they'll be competing with the local government funding agency if those regional entities get a credit rating as high as the LGFA. So it may well be that the LGFA is having to compete with another issuer into that market, would suggest that those credit margins could tend to move higher from here.
Because as a competitor, given that the corporate entity would be government guaranteed, we don't have that asset. There isn't going to be the same level of security. Is that what you're suggesting?
I suppose the security for council is its underlying ratepayer base. So the security that council offers to the LGFA in terms of the repayment of those loans is the ability for council to levy a special rate on its ratepayer base. So the security that council offers isn't the underlying assets of council's business. Yeah, it's the ratepayer, the ability to rate the ratepayer, and also that statutory charge. Yeah.
So does the same not apply to the corporate entity?
It's a very, I would say that they'd have to, I haven't seen the detail, and it's, as far as I'm aware, they're still going through discussions with their advisors and Standard & Poor's and the government, because I think at the end of the day, it's the ability for and willingness for the government to provide that guarantee. Because when we were setting up the LGFA back in 2011, that would have been a very easy credit enhancement for the LGFA, but the Crown wasn't willing to give an unlimited guarantee, just 20% ownership of the LGFA. So I'm not too sure where those conversations are with the provision of that guarantee by the Crown, but that would certainly be a key input into those new entities being able to credit rate as high as the LGFA, in my view.
I just feel so sorry for the ratepayer, because they're the only place source of any money for anybody is them.
Yes.
Oh, can I just have one further question, Brett, if I may? I'm just wondering what your view is on the borrow and spend mentality, which is pervasive through the Three Waters narrative, without consideration for paying off capital.
And the borrow and spend narrative, yeah. Did you want to articulate that a bit further?
Well, so all the government talks about is borrowing and spending. It doesn't talk about an economic package which actually sees the paying down of capital works. But I guess potentially it's a rolling maul, if you like. It just looked like it was solely a borrow and spend rather than paying it down. Yeah. I guess we still haven't had a lot of questions answered around reserves, development contributions, and the like. I can't explain it any further than that.
Yeah, I
it's
like
all right.
Analogy.
You don't have to, Brett. It's all right.
No, I like your analogy of a rolling maul.
We hear you vexing, Sandra.
Yeah.
Sorry, what was that?
I like the analogy of a rolling maul.
Yeah.
But I think that there'll have to be some program of repayment of loans, because I suppose, you know, over the shoulder of these new entities will be a Standard & Poor's, right? That would be wanting some sort of fiscal and financial sort of management to ensure that, and there will be debt. There'll be debt caps on the entity as well, to ensure that debt levels remain at appropriate levels for that entity relative to revenue. There will be some fiscal envelopes around it.
Well, who's going to impose those?
Well, certainly if they're seeking a strong credit rating, they will have to go with it. So, and that's one of the reasons why local government sector in New Zealand is so well credit rated, is because of the financial framework that we operate within, and that starts with the legal and regulatory framework that we operate within. There will be a similar sort of framework for these entities. You would have thought.
You'd think, but I don't trust the system at all.
Brett, I wonder if I can invite you to continue, please.
Okay. Thanks, Bruce. the LD markets and the interest rate markets. So what does that mean for council? And when we meet monthly with Donna and Hayden, we're looking at the risk position of council. And one of the key inputs to that is the debt forecasts. And importantly, we like to scenario test our risk position, because we're always looking forward in terms of the interest rate and funding decisions that we're making at council. And so we have 3 debt forecasts that we're working towards. We've got the LTP debt forecast, which has been the debt forecast that has been consulted on. We've got a haircutted debt forecast being the yellow line, so haircutted at 20%. So that is making some assumptions around the delivery of the capital program and also carry forwards. And this is the line that we would be typically managing ourselves to. And what we've also put into the debt scenario is a 3 waters debt forecast. So making some assumptions, as Hayden was mentioning earlier, that the assumption that our debt goes with the external debt goes with the assets or is repaid based on consideration from the new entity, we will repay that water-related debt, and that creates quite a reduction in our debt position. And then this debt forecast here beyond the 1st of July 24 is assuming that debt is related to other activities across council. So those are the 3 debt scenarios that we would typically be mindful of in the context of managing ourselves to policy limits, and also wanting to ensure that we have the flexibility within the decisions, the medium to longer term decisions we're making today, so we don't get ourselves into an uncomfortable position around our treasury positions. So this should be a familiar page for you. June 21, based on an 80% LTP debt forecast, the haircutted debt forecast, ticks across the interest rate compliance, funding compliance, and liquidity compliance per the policies. There's that 61 million of debt, and across our counterparties. So, and here is the investments that were on the balance sheet as of the end of June. This page is a snapshot of our profiles at the end of June. So here is our interest rate position. So our debt forecast, our maximum and minimum percentages that we need to manage our fixed rate percentage within, and we're sitting above that minimum parameter. And these are our percentages that we've got protected as we go out against our long-term sort of debt forecast. So you can see our risk management position is going to be very sensitive to what that debt forecast is. On the right-hand side, we've got our funding risk position. And as good, prudent financial managers, we are spreading our maturity profile. So if we think about 61 million of debt, and we've got 10 million of bank facilities, making 71 million. We've got that spread over maturities dated from 1 year's time out to sort of 2028. So we were sitting within our risk percentages here relative to those time bands. So we've got a spread of debt maturities. That means that We're not trying to refinance all of council's debt at one point in time, because there's risks in that, and we're sort of spreading and smoothing those decisions over time. If we think about our interest rate strategy, these are the things that we're talking about at our Treasury meetings. So using the 80% debt forecast, and we project our position forward to January 22, what the tool is showing us is that we are going to be falling below our minimum policy requirements. So we're thinking about, we need to be maintaining at least our policy minimum percentages. So we're looking at interest rate swaps to transact on a forward start basis to manage that non-compliance, and that is taking up our risk position up at those particular points where we are sitting below our, potentially proposed to be falling below those risk percentages. And this here is the impact of the interest rate swap strategy that we're recommending to manage that risk. You know, Hayden did mention earlier the blend and extend. Remember earlier I talked about that flat interest rate curve out to 10 years. We will also look at the blend and extend and see whether there's going to provide us with additional benefits to reduce our borrowing costs today, rather than getting the benefit of those lower interest rate swaps starting in 2024. But the impact will be the same in terms of the profile around managing that risk. Also, when we're thinking about interest rate risk, we've got to think about three waters, okay? And that was our third debt scenario. So we know that if we put a three waters debt forecast into the tool, we don't go into policy and non-compliance. So we're just going to need to make sure that any actions we take today is not going to put us in a situation where we're over-hedged in the future. So that's how we use that scenario of the three waters. So we have been quite conservative in the way that we've looked at the interest rate position. We've assumed that interest rate swaps that we have today will stay with council, but we would be advocating for, as part of the three waters transaction, that they not only assume the debt, but also there's a portfolio of interest rate swaps that they should be assuming is attached to that water-related debt, which is part of the transaction. But these are the things that we're thinking about in terms of forward managing our interest rate sort of risk position. Is there any questions around the interest rate strategy?
Sorry, I just had a point. Is that that last comment that you said, is that something that we should be taking note of, or are staff already going to be including that in the feedback report for Three Waters? It's probably not a question for our finance man, but more for staff.
Yeah, at the moment, we're reporting to the 80% measure.
Yeah.
But we just, as part of our conversations in the Treasury meetings, just thinking about, what do things look like in the future, and what are the big changes around the balance sheet, and that'll be around debt, and making sure that we bring that context into the recommendations and decisions we make today. So this swap strategy here, we'd be comfortable sort of recommending, because it doesn't put us into an uncomfortable position in the future, given where debt is likely to move to. So it's more of providing the sort of the context and input into that conversation,
Okay.
but recognising that we're reporting to this measure here today.
Okay.
Does that help?
I think so.
Just through the chair, Donna here, from a staff perspective, we definitely are talking and will be the interest rate swap portfolio certainly is something that is part of the big financial picture that will be posing back in our responses back to the DIA as well.
Yeah,
we're already well aware of it.
Thank you for that, Donna.
Brett, can I ask a question, please, about the scenario testing?
Yeah.
There's always a slight, how shall I put it, irony that we're already anticipating 80% against our LTP debt forecast. What happens if we actually meet our LTP debt forecast?
So the question, sorry, Bruce, is what happens if we meet
What
the debt
happens
forecast?
if scenario one, what
Yes.
we actually planned we do,
Yeah.
because we've discussed before, gives rise to our net debt position.
Yes.
How flexible are we to meet that condition rather than the 80%?
Yes. I think that certainly an input into the conversations every month is how are we tracking relative to the debt forecast. So I suppose that 80% is a living and breathing debt forecast. But you're right, that is the question, what is our risk position relative to the LTP debt forecast?
Yes.
But yeah, are we at minimums or not?
Look, I think it's an imponderable here, because I think what you're saying to me, Brett and Donna, is that we're best to scenario plan at the 80% level. It just begs an interesting question about our LTP forecast, that's all. And equally, we've also had earlier in the session, not quite, Brett, but essentially, that discussion around the doability, the delivery ability on the LTP forecast, which assumes, of course, 100% delivery.
Yes.
And I'm just, wanting to reflect, it doesn't look like that's possible, particularly given the current lockdown and indeed some of the cost pressures on projects. But there is a chance actually we might head towards it. That's what I'm trying to reflect through. And I think your answer is that this is the Donna and Brett meeting and Hayden meeting monthly, which gives you a chance to be sensitive to our actual performance, correct?
Isn't it?
Yep,
And
that is
things
correct.
are changing as they are. Yeah. And look, we don't want to get ourselves into an uncomfortable position that we're hedging to an LTP debt forecast that has a high probability of not being met for a lot of good reasons. That would be a situation where we would have a lot of flexibility going forward. So yeah, trying to be conservative, but sort of mindful of what's happening on the ground as well.
Brilliant, thank you.
Yeah, so I think just summing up around the interest rate strategy, keeping an eye on those policy minimum percentages. We use interest rate swaps to manage our fixed rate position, or reprofile those existing swaps. The flat slope of that, the interest rate curve at the moment is important for us to be transacting longer dated forward starting swap instruments. So the market environment is actually improving for those types of strategies. And at the moment, we're targeting those long-term rates sort of slightly lower than where they are to sort of maintain that hedging position. And we're also mindful of making sure that we're not only compliant month by month, but also compliant at June 22. So that's our sort of horizon on which we're looking at. And look, again, that comment around Three Waters and what's happening with swaps as part of the Three Waters transaction is obviously in our minds as well. So those are the sort of general sort of points and themes that we're thinking about in our monthly meetings. In terms of debt, look, over time, again, it does come back to delivery of the capital program and the debt forecasts, because higher debt levels means that we need to maintain a certain amount of liquidity or liquidity capacity. So that's important for us as we sort of move forward from a debt funding perspective. Ideally, we sort of raise the debt as we're spending it. There is a sort of a holding cost to raising debt sort of too early. And also the management of the existing portfolio. So, and look, we also need to be thinking about debt forecasts beyond July 24, where we see that debt levels could be reducing to 44 million before growing slightly on those outer years, you see. We're just going to be mindful about, because the overall strategy from an intergenerational perspective would be to lengthen the maturity profile. And it comes back to that, that comment earlier about those credit margins are very, very low from where they have been historically. And our bias and outlook would be there, be across the page and higher from here. So we want to do what we can to sort of capture those low funding costs into the future. And we're also recognising that, over time our debt maturity profile shortens. So more debt is rolling into that 0 to 3 year period. So the policy is encouraging us to continue to lengthen the maturity profile of the debt portfolio, but also stagger the maturity as well. So some of the things that we're thinking about is we've got 6 million of debt maturing in April 22. So we typically, and the policy allows us to pre-fund that up to 18 months out from today. So we're thinking about refinancing that through the LGFA at an upcoming tender date. We'd typically the recommendation would be to go longer rather than shorter. And that's a piece of our debt portfolio we know that we've got from an intergenerational perspective, so we can essentially deal and manage to that as best we can. Term deposit rates have increased, particularly with the market expecting that OCR to increase. So it doesn't necessarily follow that these are holding costs for pre-funding debt when you're putting it into a term deposit of 6 months plus, or 5-6 months. So that's something we're mindful as well. Also think about new debt as well for liquidity purposes, just in terms of funding the upcoming capital plan. So again, thinking about raising that new liquidity in a debt maturity around that 2027 mark at good long-term historical credit margins. So making sure we've got compliance in our policy. We can see that in January 22, we're going out of non-compliance around our 0 to 3 year percentage. We've got the ANZ Bank facility, which we use for our working capital requirements. We know that that's sort of maturing, and so we need to just continue to roll that out to ensure that we have got that committed facility available for us for short-term borrowing needs. And that earlier comment about liquidity capacity, we just know that as our external debt amounts increase, we have to increase the amount of liquidity. We do that through the size of our bank facility and we certainly can raise a standby facility with the LGFA, and or we do that through cash, holding more cash on balance sheet. So those are the things that we're thinking about from a debt funding perspective. So if we look at our maturity profile and we think about raising new debt, so there's the 6 million that we've raised, so that's 12 million in total. 6 million of that's put on term deposit to manage that upcoming maturity in April next year. You can see our liquidity ratio improves, which is a tick for us in terms of what we're trying to achieve, particularly as debt forecasts increase, and our maturity profile improves as well. You can see we've had 54% of our debt maturing in the 0 to 3 years. We've started to put more into that 3 to 7 year time period, and we're starting to sort of spread that maturity profile out across the policy limits as required. So I can stop there and take any questions around the liquidity and funding strategy.
Yeah, so this is the coup de grace, really, isn't it? This diagram, Brett, in terms of the lead up you've given us, both around the market conditions, the immediate needs that we have to think about relative to our LTP, 80%, 100% water-related debt gone, and that this is the outworking of that, which has been very thorough. I hope, members, it is important that you are comfortable with this. One of the key roles the LGFA looks for audit and risk committees is that it is actively managing its treasury management policy. So, look, I'd ask you to be, even though we're taking substantial time over this is a substantive session for us. So I would be very open to you asking Brett any questions that would help you make certain you're comfortable with this. Thank you. Any questions? Perhaps we've blinded them by science. No, it's good accounting. This is good to see numbers on the board, Brett. Donna, is there anything you want to say at this stage before we keep moving?
No, not really, other than the fact that we actually have already done that borrowing, Brett. We did it in the August tender, not the September one, which was what was.
Oh, right. So we've done it.
Which was what was advised to us to do.
Right.
Yeah.
Right.
Yeah. We just needed to sort of get the information into the tool. Yeah.
Yeah.
Okay.
Yeah. So that's fine.
Okay, if you've got a summary page, it might be worthwhile just following through, and then we'll go back to the recommendations if that's possible, please.
Yes, look, just in summarising, we just continue to be proactive around that management of our treasury risks. So important for us to project forward and scenario test the risk positions. Debt forecasts, are critically important for us in terms of making those medium to longer term treasury decisions. Look, the Reserve Bank is going to remove those that COVID stimulus, so we are going to see that OCR increase, but that lends into the flatter swap curve as I was talking about, so that creates the opportunity around the blends and extends or forward start swaps. Again, LGFA is offering those very low credit margins at the moment, so we're wanting to sort of transact into them whilst they're there, and do the pre-funding and new funding needs as required as we go forward over the next sort of 6 to 12 months. So that was really my presentation in terms of what we're thinking about at the moment in the monthly meetings with Donna and Hannah and Hayden.
It's very helpful, and I guess in relationship to that last point, Donna, you're just indicating that in effect, the strategy that's outlined here you've implemented.
Yes, yes.
Yeah.
Okay.
What is our sort of crimsony 6 million at year 6 and 7 can be more substantively coloured in there, in effect, if I was going for colours. Right. Brett,
Yes.
thank you for that.
Okay.
You must have felt like you run a marathon. I found it very stimulating to have your presentation, and it is really important. So thank you for that. I wonder if, for the benefit of the members, if we could please just return to Hayden's original paper, which is 4.2, the Treasury update. And it's on page 57 of the agenda. And it's simply saying that we receive the Treasury update report. That seems a wee bit limited in terms of the totality of what we have heard today. I'm going to leave that as that motion, but I do want to reflect that actually in receiving it, we are acknowledging the strategy that with Brett's advice, and it's not Brett's policy, it's our policy, that Donna and Hayden are pursuing on our behalf. So I just want to reflect that as we receive the report, we are in effect, this is our chance to comment on and in effect affirm the way in which this is being pursued. So I'm comfortable to put the motion that we receive Hayden's report. Do I have a seconder, please? Somebody will have to put their hand up, I can't. Pardon? You're seconding, Sally? Brilliant, thank you. Yes. Appreciate that, good to see you there. I'm going to put the motion then, please. All those in favour, please say aye.
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 Those against? It's carried, thank you. And for the sake of good form, I should also move to 4.3, where I will move that we receive Brett's presentation. Brett, and again, I just want to personalise my gratitude. We keep seeing each other by way of video rather than in person, but I do appreciate the thoroughness and the clarity with which you have taken us through Thames's position today and taken our questions on board. Well done. I appreciate that, and reflects a strong level of comfort with the work that you and PW are doing with Donna and Hayden. So I do appreciate that. So I'll move from the chair that we receive Brett's report. Can I have a seconder, please?
I'll second that.
Thank you, Murray. Cool. Appreciate that. I'll put the motion. All those in favour, please say aye.
Aye.
Those against? Carried. Thank you, buddy. Brett, thank you for that. We can probably release you now to say your other work. Perhaps it's a chance for a break, cup of coffee and a glass of water or something, but
yes.
Appreciate your time.
No, thank you, everybody. Thank you, Bruce and all. Bye.
Thanks.
Bye-bye, Brett.
Bye.
Well, I'd like to keep pushing on. We've had a fairly long session already today, but thank you for that, Hayden and Donna. That was really important, probably the big substantive stuff. We still have to rattle through a wee bit of business, including public excluded, and I would like to try and keep ourselves reasonably to time. So Hayden, sorry, if I could move straight on, please, to the debtors update, that would be useful, please. Hayden, you're on mute, mate.
I'll take the report as read, but through the chair, I think the big thing with our debtors is just the improvement year on year. I think has been quite significant, going from last year having total rates debtors of 7.6 million down to 3.2 this year has shown significant improvement, and it's something that we're continually looking to improve on, and there's still quite a bit of work to do, but yeah, I'll take any questions Yes.
So Hayden, I've got a question. Where does that that improvement has come by? Just more assiduous collecting, or how's that mostly come about?
It's come about from probably there's a number of things that we've sort of tried this year. We've used external agencies as sort of a last resort, but we've used Bay Corp and Cavill Leach, where we've some more of our difficult, outstanding sort of debtors. But we've also done things like joint recovery efforts with Waikato Regional Council. We've had huge assistance from our legal team, our internal legal team. We've also used the mortgagee for collection where we can, and we've really pushed arrangements to pay with rates debtors where we can. So yeah, it's sort of been a number of different things really.
Okay, thank you.
Any comments you'd like to make about the sundry debtors, Hayden?
Sundry debtors is pretty much held year on year. There's sort of there's definitely improvements that can be made in that area, but it's probably, we need to take probably a similar approach to what we've taken to the rates, is use more than sort of just one avenue where we tend to just we definitely try and work with our sundry debtors, but we probably just need to be more active in that space to try and get that figure down.
Hear your point. It's thank you for being transparent and honest. The question is, have you guys got the capacity to do that?
Yeah, we've got the capacity. It's just probably being more targeted, I think, of our time.
Brilliant. Any other questions, members, on the debtors? Good to see it going down. Cash in the bank's better. Any other questions from folk? There being none, let's move to the resolution, please, which is that we receive the debtors update. And Hayden, in doing so, again, don't want to just rush over that without acknowledging staff and the strong movement there in terms of rates outstanding. Possibly a different meeting would have had a lot more focus on that than we have this morning, given our agenda. But well done. So thank you to you and your team for the work that's been done there. So I'll move that we receive. Do we have a seconder, please? You put their hand up. I can't see you. You probably have to use the hand facility or yell at.
Martin.
Thank you very much, Martin. I'll put the motion, please. All those in favour, please say aye.
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 Those against, it's carried. Thank you. Can we move to the rates remission? Oh no, Judy, not you, Hayden. How's that? You're left free now. G'day, Judy. How are you?
Good morning.
Yeah, an industrial warehouse by the looks of it. So welcome along.
Thank you. So I'm just reporting on the rates remission and postponements for the year that ends on the 30th of June. I take the report that it has been read and just emphasise on some changes that we have had following on from Hayden's report as well with debt collection. We have had some increases within the remission side of the in the council, and some of that relates to making sure our data is all clean and contacting people sort of to give them an update of when things are actually due for remissions, not leaving them for them to contact us. We're trying to be a little bit more proactive in that way. And also with the changes that have been made to the Whenua Maori Amendment Act, where that gave the CE the delegation to be able to remit some rates that were deemed unrecoverable, that has actually increased the amount on that remission as well. So overall, it's all, I can see that it sort of follows in line with the amounts that were from the previous rating year. And I just want to see if there's any questions on that report.
Thank you for that, Judy. Agreed. So chance for our annual look at the level of remissions. Any questions for Judy, please?
Yes, Martin here. I just had a question. The miscellaneous purposes, both the number and the amount seems to have gone up significantly. Is there, I don't know, I know miscellaneous is probably just everything you couldn't fit into the other categories, but is there anything in particular in that miscellaneous?
There was a couple of properties that had been that had quite substantial rates outstanding, and they were in the 1877 agreement area. So when there was we weren't able to actually recover the debt, it was brought to council to remit that debt so that we could go ahead and sell the property.
Right.
Yes.
Okay. Thank you.
And just through the chair, the miscellaneous purposes, all remissions that are made under those come to the Audit and Risk Committee for approval, and so they've all been through the Audit and Risk Committee.
Right. Okay. Thank you.
So you've been more lenient than usual, Martin.
Well, me personally.
Numbers say it all. The numbers got to be right. I joke. Sorry. Right. Is anything else people would like to raise with Judy? Thank you, Judy. It's something which I'm sure at the stage which you set rates each year with the annual plan as well, with keeping in mind this has some of the impacts of the rating remissions policy that goes into play. Could I please look for a seconder? I'll move that we receive Judy's report. Thank you. Do I have a seconder, please?
Yes.
Please.
Sally.
Sally, thank you, Sally. Just need to yell out your name because we're only going on voice, so that's fine. Sally, thank you very much. I'll move the motion. All those in favour, please say aye.
Aye.
Those against? It's carried. Thank you. We move on to item 4.6, which is a very interesting report on the communication survey affected members. And I think, Lorna, you're here. Thank you, Lorna. Could you just give us a heads up? You can treat it as being read, but your thumbnail or key points, please.
Good morning, everyone. So this is just a report that we are now taking to the Audit and Risk every 6 months to give a sense check that our business is meeting elected members' needs around their communications, and also to get a sense on what our communities are telling our elected members. So as you'll see in the one pager, the double pager, there were several elected members, not councillors but community board members, who just didn't get back to us in time for the deadline to respond. So what we have done is just, we did this survey particularly after the adoption of our LTP, just to get feedback on the communications and the engagement with our consultation campaign, and also conveying the decisions to the public about the LTP. Some of the points that you'll see in there is overall that appears that the majority of the elected members are satisfied or very satisfied with the communications that we're providing to yourselves and generally to the communities. We're noting that some of the comments that you provided about what the communities would like to hear more about, so that's something that we're taking on board in terms of campaigns. There have been some requests also that communications share more about the list of legoimas that we're receiving on a weekly basis. So that's actually being provided to you now in the Councillor's Weekly Update on a Friday, the new list of all the legoimas that we're dealing with, just to give you some context on that. And just another point of note, we saw some of the issues that you were more interested in us promoting, or we do more about. So we've had a look at that, and some of the campaigns that we've undertaken over the past few months include the waste minimisation one, where we've done Bin the Bad Habits, which ran for the month of August. Unfortunately, we've had to cut that slightly short because of COVID, because we haven't been able to help promote the rubbish and recycling messages so much over the last couple of, 10 days or so. And also we're doing quite a push on tsunami planning and signage with our emergency management department. Just some of the things that we're producing more on over the coming months will be about the Three Waters reform, and following just some feedback over the last week, there is an email now that we've established, and that is threewaters@tcdc.govt.nz, which we're putting to the webpage on our website, and we'll be doing a bit of a push around that on our Friday's project press release, which goes out this end of this week.
Cool.
Thank you for that, Lorna. Appreciate your preparation. So look, that's interesting. As you say, my reading was certainly that general comfort, and indeed the last question was interesting to see where constituents might be at. Do members want to make comment or raise questions for Lorna at this stage, please? I see Terry, you've got your hand up.
Yes, Lorna, the Three Waters communication on the website. So people who are concerned can go into there and leave a message. Is that right? Is that what I'm reading? How is this?
No, what we're asking, and we'll put some communications around this, is that this is it's being led by the government. There is on the DIA website feedback for the New Zealand public to send their thoughts and views. This is just to get a sense from our communities about their views and their feelings, which we will collate and at some stage bring that back to the elected members, just so you're getting a sense of what your communities are saying.
So just to get that right, they can put a comment on there that you'll collect together and bring back to the council.
That there is an email address that we'll be promoting, and so they can send an email to that 3waters@tcdc.govt.nz. So we'll be collating all those emails.
Thank you. That's good. Thank you.
Any other questions for Lorna, please? There being none, I'll move to the recommendation, please, which is that we receive Lorna's report, noting the 6 monthly update. Thank you for that and some of your intended program going forward. Could I please have a seconder?
Yeah, happy to.
Thank you. I think it was you, Terry, with your hand up. Brilliant. I'll put it, please. All those in favour, please say aye.
Aye.
Those against? It's carried. Thank you, Lorna. Right, members' reports. Perhaps rather than going round, is there anything that's burning on people's minds that they would like to raise at this point that is related to risk?
I've just got a couple that I just want to raise, and obviously one's the Three Waters and where we're going and about engagement. I think that's a big risk for the council's future. And the other one is the execution of the capital works program. Those are my two major issues. Thank you.
Right, I think we've already, can I take it, Terry, that you have obviously had a chance to raise those during various parts of the meeting. You're just effectively covering off what are your two big issues, right?
Correct, and just the engagement side that Lorna's just discussed is great. Thank you.
Thank you. Anybody else want to report anything at this stage? The only thing I was going to note that I had prepared for this was to recognise, and I'm sure you may be aware, and it comes again from Three Waters, that there has been, I think it's public now, so I don't think I'm talking out of turn, a move by some of the southern mayors to ask the minister to take a pause on Three Waters reform on the basis, in effect, that to do so, well, rather to allow, I keep calling it Bill Bayfield's kingdom. That's very ungracious. It's mainly because I keep forgetting the name of his institution, but for the regulator to be stood up and for us to get a better understanding and handle of the future costs, which is so critical to the pricings of the models, to be established. And also to enable actually what would have been ideally done by now, which is the future of local government to be completed before actual reform went through. I don't know how you folk would reflect on that as a strategy, but it's one that's gained reasonable traction across a reasonable number of the mayors in the South Island, and they, as I understand it now, if they haven't, they will be making that public and presenting that idea to the minister. Will it have any traction? Have absolutely no idea for what is a government-led initiative, but I presume you folk have heard about it. And if you haven't,
Bruce, have they give a time period? Like if take a pause, have they give a time period within that pause?
Actually, it's a really good point. No, there is not necessarily a statement about the level of the pause because it's really dependent on two things. One is actually the establishment of the regulator, and actually what is the regulator's expectations and cost drivers that will affect the future pricing of the delivery of Three Waters, which after all is the fundamental of actually, as I said, the WICS reporting in terms of future costs. So that's that plus the future of local government, which was designed, I think, to report what in 2023. This would suggest that the actual formation of the entities, or rather pursuing actually the decision making and the formation of the entities, should be pushed out at least, well, a reasonable distance past 2024. Sally, I can see your hand up.
The way I read the news this morning, the ministers responded by saying that they're politicising the issue.
And that's why I said I don't know where it will go, Sally, but I just wanted to reflect politically some of the feeling, dare I say it, from down this way. Tony?
I just again raised to me that Three Waters, local government reform and RMA reform, part of smokescreen for HPP. And I think some stage someone's going to have to say, what's the deal on who owns the water? Because that will change the milk and the coconut when it comes to price.
Right, thank you. This is the nature of having reports out there. I think we've got things. Thank you for that. Is there any other comment people would like to make at this stage under members' report? There being none, I just ask that we receive these verbal reports. I'll move that. Do I have a seconder, please?
I'll second.
Thank you very much. All those in favour, please say aye.
Aye.
Those against, it's carried. Brilliant. Right. Next, section 4.8 is a proposal to move into public excluded. For the reasons that are stated there. Just bearing in mind we are dealing with the minutes of the excluded session, a water emissions application, Mr. Barlow's, an assurance report from in litigation report. For the reasons that we've got there, we're proposing to deal with those in public excluded. I will move that. Do I have a seconder?
Seconder, thank you.
Thank you very much. Is there any discussion on the motion? Donna?
Excuse me, just before we go, could we just confirm that the recording has been stopped and that all public are offline?
They probably hear us do